Hey, everybody, we are going to talk about everybody's favorite investor, Warren Buffett, and specifically Berkshire Hathaway. Dan and I are both buying shares in 2024, even though it's already one of our largest positions. And it just hit a fresh all-time high right before we recorded this. So before we dive in, please take a minute, check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from our sponsor, The Motley Fool. The best way to support this work we're doing on YouTube, again, fool.com/Frankel. So then Berkshire's kind of had an interesting year so far, to say the least. Um, we all know about the Apple sales. We're going to do a separate video on that, by the way, everybody. So be sure to check that one out. One kind of real interesting thing after that Apple sale is Berkshire has three components to its business for the most part. You can break everything into one of these three categories. The operating businesses, that's things like Geico, things like Berkshire Hathaway Energy, the stock portfolio, which still has a lot of Apple stock and about 4 dozen other names in it, and cash. Berkshire has a lot of cash. I don't think I read this incorrectly. Berkshire has more Treasury bills than the U.S. than the Federal Reserve right now. It was something to that effect. There was a CNBC headline on that. Don't quote me on that exact one, but it's some like crazy stat like that. Berkshire's cash is paying it $14 billion in annual interest. There's a stat that I know for sure. But one of the interesting things, Dan, after the Apple sale, is that all three of those components are roughly the same size now in terms of the percentage of market cap they represent. Berkshire's roughly a $900 billion market cap company, and all three of those things are about $300 billion of its value, which is kind of interesting. So it's not like it used to be like cash was kind of like, okay, Berkshire had, 100 billion and it wasn't, a giant part of the business. Now it is. So let me kick it to you first. So why are you still buying? I think you buy Berkshire pretty regularly, correct?
Reasonably so. I don't talk about it as much. Being a Motley Fool contributor meant that every time that I would talk about Berkshire Hathaway, I'd have a trading stop on it. And so when I was writing more, when I was doing more, when I was talking more about it on an everyday basis, that really did put a crimp in the amount of purchasing that I did. But it is a large position. It has always been a large position for me, and its growth has only made it a larger position. But largely because of what you just said, I almost treat it like those three different entities. And so you have Berkshire Hathaway, the operating businesses. You have Berkshire Hathaway, almost the closed-end fund of stock portfolio holdings. And then you have Berkshire Hathaway, the massive cash reserves. All three of those kind of serve a function in my portfolio, and it's why I feel more comfortable with a concentration of a position in that stock that I wouldn't feel comfortable with just with any particular company. Even some of the larger tech companies, many of which do in fact have pretty large cash holdings of their own, but Berkshire is kind of a creature unto itself, and that's been why I've been comfortable with that as such a big holding. And yeah, I do make pretty regular, I take a look at it regularly. And when I do have, on those rare occasions, I do have spare capital available, it is always on the list of things to look at.
Yeah, so I've written a few articles about Berkshire, and I've said this a very similar thing a few times. If I can only own one stock, it would be Berkshire, because it's like buying a whole investment portfolio in one. You're essentially buying Warren Buffett's investment portfolio, right? He's got he has an individual stock portfolio of his own, but it's relatively small. And one thing I love about, and people ask me all the time, why don't you just buy Apple stock, Bank of America stock, and et cetera, et cetera, et cetera? And my answer is because you can't invest like Warren Buffett. He gets deals that you and I can't. Think of where the Bank of America investment came from in the first place. He bought a bunch of, he made a sweetheart deal with Brian Moynihan, bought, I think, $5 billion worth of warrants in the wake of the financial crisis, and had the right to, got a bunch, or bought preferred stock, and it came with a bunch of warrants that he didn't pay for. And so he essentially paid $5 billion for Berkshire's Bank of America stake. None of us could have done that. It's a deal that no one could have gotten. And as the business scales, the next time, we really haven't hit a deep recession where the market's crashing like that, with the exception of the initial part of the COVID pandemic. We really haven't seen like a market panic since that 2008, 2009 period. And the scale has gotten so much bigger since then. And Berkshire has $277 billion of cash available. If 2008 happens again, some companies are going to need it. Berkshire's in a great position to make a whole lot more of those type of deals if it comes to that. I consider it to be the best stock to own if going into a recession too. I'm a big fan of that. So Dan, let me ask you one question. So out of the three, well, I have two questions, but out of the three parts of the business, which one is your favorite component of Berkshire? Is it the stock portfolio that can get deals no one else can? Is it the wholly owned businesses that you can't invest in directly anywhere else? Or is it that cash that gives it the tremendous financial flexibility? And you can't cheat and say all of the above.
Oh, you just got me. I actually do believe that what I've found in my long ownership, and I've owned Berkshire Hathaway dating back to the 1990s, is that at any one given time, I can point to one of those three sides of the business, and I will say that's my favorite part of it right now. The thing is that changes over time. So if you're asking me what I like right now, boy, that's a tough one because I really like the energy side of the operating businesses. You've got the insurance stuff, and the insurance stuff kind of chugs along and it does its thing. If there's any concern I have about the insurance business, it has to do with some of the risks that we're seeing with changing weather events and things like that. If anybody's going to be able to protect against that, it's Ajit Jain, who's running the insurance operations, and it's Berkshire because just of Berkshire's size. But at the same time, I kind of like, energy's been kind of in and out of favor lately. The valuations there look a lot more attractive. Buffett himself can't seem to buy enough of Occidental Petroleum. It is a common purchase that he makes, quarter after quarter. We see that happen. And I can understand why it appeals to that general sense of value. And so at this point, that's kind of what I'm most comfortable with. The stock portfolio has been such an Apple story that it really goes into what you think about Apple. Like you mentioned, we're going to do a whole different video on that, so I won't get too much into it. But those deals that you get, hey, if any big company wants to come to me, offer me preferred stock with an 8% dividend, 10% dividend, convertible at will, and give me some warrants to pick up some equity at a low price that don't obligate me to do it, hey, I'm your guy. I'm right there with you. But barring that, I'm happy to be a Berkshire shareholder and let Warren do those conversations for me. And so that has its place. I don't think that now is the time for that. I think where the cash is going to be handy is, let's face it, Buffett's in his 90s. We just saw Charlie Munger pass away recently, and there's a time limit. There's an expiration. I think having all that cash handy will give the folks who are going to be running Berkshire afterwards the ability to do some things they wouldn't otherwise have been able to do. I'm looking forward to what that looks like. I think Greg Abel has plenty of ideas. You might not hear about him all the time in the shadow of Warren, but he'll do a good job. I have all the confidence in the world in him.
Yeah, and I have similar feelings about the cash. I'll be clear, I hated the cash position when interest rates were nothing. Now that it's become kind of a productive asset, I mentioned it's earning $14 billion of annual income for the company. It makes a little more sense, and I agree with you. Like, to be clear, I hope Buffett's around for a long time to come. But he's even said he knows he's playing in the extra innings, is the way he put it. But I do think he's kind of building up some cash. So one, his portfolio managers, Ted and Todd, can truly make it their own without having to make the tough decision to sell what Warren Buffett bought. They can't sell the Coca-Cola stake. That's what Buffett's known for. But if you give them that much firepower to really make their own decisions, and they've made some really good investment choices. They're the ones who initiated the Apple stake originally. I think it was like a $1 billion tiptoe into it for Berkshire, but it initially came from them. So I think he wants them to make it their own. But I'm really curious too to see how it turns out. My personal hope is that Buffett retires at like 95 and lives another 10 years. But who knows? We'll have to see how it plays out. But I love the stock. I have no plans on getting rid of it anytime soon, regardless of who's in charge. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.